plant, but soon I'm switching to my own firm, which is Vista Intelligence Private Limited. And this organization aims to do market research in artificial intelligence. So Ticker possibly will remain a carrier of Vista's output, and this Vista Intelligence will carry out the research in financial markets. So that's what I am. I have around 22 years of experience in primarily in financial markets, including media, including exchanges, etc., etc. Now, what I plan to do in this very short time of around 50 minutes, what I wrote to all of you in the morning, it is split into 4 or 5 things. The first thing I would like to use my first thing would be I would like to use my MS Word writing pad so that you can all see what I'm typing. And in the last part, when I'll be talking about the electricity market, I'll switch to a PPT presentation, which is very small, just to make you familiar with certain graphs and other things. Just a second. Yeah. So how do I share my screen? There is a share option.
So you just have to go to the bottom. There is a share screen tab.
Yeah.
And you are already.
So I have shared my Word page. I think you guys can see it on your desktop or iPhone, whatever you are using. So exchange traded markets is somewhat different from your conventional spot market. Now, possibly we do understand what is meant by exchange traded market for shares, currencies, because they are most hyped and most talked about. But please remember while you go forward in your life's journey, that this equity market that we most talk about in pink papers or in digital media or elsewhere is the smallest of all financial assets that is traded on exchange traded markets. So how small it is, just to give you an idea. So if you consider equity traded market as 1 unit, then commodity traded market is roughly about 10 times more than the equity market. Now, when I talk about the exchange traded market, I'm not considering the physical market for commodities. But when I'm talking about the equity market, I'm also including the shares traded on the cash platform, which is basically your spot market equivalent of commodities. So 1:10 is the ratio between the size of your equity and commodity market. Now you move to the other asset, which is your currency. This market is 100 times bigger than your equity market, or 10 times, therefore, of the commodity market. You move to the another asset, which is also traded on the exchange platform, which is your fixed income products like bonds, etc., government bonds or corporate bonds. This market again is 10 times more than your fixed income market, currency market, therefore 1,000 times more than your base, which we considered as equity. So equity is the smallest of all markets. Today we'll try to talk about commodity little bit and electricity, which is also considered as commodity, but commodity not in the sense which is storable and other things. So it is not storable commodity. So far in India, this electricity is not allowed to trade on conventional stock exchange platform. It is only traded on a designated, specific and regulated platform, which is like IEX, PF. There is one more, which is almost defunct now. So there are two electricity trading platforms in India now. So when I talk about exchange traded platforms, remember a few features of it, of this market, which is very distinct from your physical markets. One is, of course, it is very anonymous. So this market, as I say, is anonymous market, right? This market, buyers and sellers are not visible. This is one. Now I talk about the second feature, which is novation. Now this is a very important feature of the market. When I say novation, that means a buyer comes on the electronic digital platform created by an exchange, as well as the seller also come, but the trades are routed through exchange. So buyers, sellers, though they apparently trade with each other, but exchange stands guarantee to each trade. So that is the meaning of novation. In case buyers or sellers, anybody defaults in their commitment to trade, then exchange rescues the affected party. So this is your novation. So this market has this feature which is not present in your physical market. So one is anonymous, second is novation. I would say third is instantaneous. Here the bargaining happens on the electronic platform, and this buyers and sellers can execute trade instantly. So every negotiations like going to market, like carrying a shopping bag, all these things are not required. Everything happens electronically and digitally, and records are kept digitally. So only when the contract mature, if it is let's say gold, if it is let's say crude oil, then only the question of delivery comes. So when I say contract mature, I am talking about a fixed tenure. So every contract that is traded on this market has a fixed tenure. So it is not like for perpetual delivery expectation and other things. So every contract, let's say 5 months contract. So I launch a contract that will expire 5 months ahead. So whatever trading that I'm entering into today have to be honored in flat 5 months time if it is pre-decided as 5 months contract. Same is for electricity. Now the question comes how it happens. So I will get into that. Now this market is regulated. This is very important as compared to uh, your let's say physical market. When I say regulated, that means there is a regulator. In case of dispute, they comes to the rescue of the affected party. They handle the grievances. So regulation is of two levels. One is at the regulator level, another is at the exchange level. So exchange here is considered as an uh, self-regulatory organization or SRO. So this is a term that is also used in the market. So here regulator in Indian context is SEBI, in US context it is CFTC, and so on. In my Singapore context it is Monetary Authority of Singapore, MAS, so on and so forth. So regulator is quasi-government body and exchange is a private body, but it has given enough power by the Act of the Land to regulate and monitor trade. But this super regulator, which is this SEBI and others, they monitor the exchanges. So it's a three-tier system. On top, you have government regulator, then exchanges, then you have the brokerage firms who are also given some powers, which are of course lesser than the two top ones, and therefore they also regulate the investors. So this is the three layers of this market. So this is very peculiar of this market, which is otherwise not present in your physical market structure. So when we talk about exchange traded market, these features have to be remembered. And the last feature, I mean, there can be 100 features which are of very distinct to this market and not present in physical market. But given the time span, I won't be able to talk everything. One last feature I would like to cover is so that you understand how it is different is your mark to market. Mark to market. How it is done? So let's say today is the day one. A is one buyer and one seller is in the market. So they trade at 100 rupees. And at the end of the day, after the trade closes, it has been discovered that the average for the day or the closing price turns out to be 110, right? Now the spirit of this market, derivative market, is always to keep these buyers and sellers at par with the closing price when the trading closes. So now what happens after the end of day one is the buyer has bought at 100, market closed at 110. So apparently buyer is at profit. If he has to sell, he can sell at 110, which is almost the average of the day kind of. Or some exchanges take last half an hour, some exchanges take last 10 seconds, etc. etc. So buyer will be credited with rupees 10. And likewise, from where this 10 rupee will come, seller will be debited rupees 10. This is the process of mark to market. In simple terms or English terms, you can remember it as keeping the buyers and sellers abreast with the latest market price. Now, the last line, let's say day two, and the closing price turns out to be rupees 90. The price has fallen for whatever information flow that might have happened in the market. So in this case, because now what, in starting of day two, these buyers and sellers at what level? They are at 110 because their accounts have been adjusted accordingly. So starting end of day two, where the closing price is 90 rupees, so buyers will be debited 20 rupees. If buyers has to reach 90, he has to lose 20 rupees, right? So sellers will be credited 20 rupees. This is how this mark to market adjustment happens in the market. So having said this, I think more or less now you understood how it is different from the physical market. So here you book a underlying, which can be crude oil, which can be electricity, which can be gold, anything, for a date which is somewhere ahead of you in the calendar, and your delivery, if it has been specified in the contract, will happen at that point in time. So when I say contract, it's a legal term because you are trading a paper basically. It's called contract. Now this contract is having has certain features. It's very interesting. So what are these features like? It will specify, let's say, quality. So in case of crude oil, I have in the case of MCX, we have specified that there are various varieties of crude oil. Let's say one is WTI, West Texas Intermediate. This has low sulfur crude oil. Then one is your this thing, what is called Brent. This is high sulfur crude oil. Then what India imports is a Middle East version. It is very high sulfur crude oil. All these varieties of crude oil are available in the market because it is dug from the under soil or under sea. Now this quality therefore has to be very rigidly specified in the contract. Otherwise buyer and seller will not know what price to quote, because price of WTI, because of different sulfur content, density, etc., has to be different from Brent and Middle East. So contract in a commodity contract always specifies a particular quality. Second, it also specified the delivery terms and conditions. So when I say delivery terms and conditions, I do mean that the date when the contract is maturing, how delivery will happen between the buyers and seller or people who are having open positions, and what happens in case there is a default. So penalty clauses, all these things are specified in this contract. Now, this contract has around, let's say, typical contract has around 20 paragraphs or 20 points, uh, so that buyers and sellers don't get confused in the market. It also specifies various things like margin money, how much you have to deposit upfront when you enter into a trade, so that in case you default, that margin money can be confiscated and passed on to the affected party by the exchange. So all these things are specified in this thing. Now, having understood this thing, let's move to your crude oil. Crude oil, when I say that, I'm talking about the Indian version. Now, India has, as you have, I mean, heard Diganto in your previous classes, I was going through a little bit of your study materials. So MCX is one, and MCX today has around 90% plus market share. Then you have NCDX. Then there are about 3 to 4 other exchanges who have hardly any, or this have must have 7 to 8% market share. The others maybe 2% or whatever. So this is how the Indian market is panned out. Now, when I say MCX, MCX when initially started, it started with gold and it was never the market leader. So I'm talking about 2003, etc. Then when we launched gold in 2004, it took 3 to 4 years for it for MCX to beat NCDX in terms of market volume and more number of participants' attention. Then in 2000, if I'm remembering correctly, 2006 possibly, February, we launched this crude oil, and I'm happy to share this crude oil contract was designed by me and 2 more people. And it was not in the initial list of 140 commodities that was there and approved by the government as permissible commodities to trade in the market. And we had to cajole with the Ministry of Petroleum, central government, etc., to allow this crude oil to get traded in the market. So 2006 we started. So when you decide what variety or what product to offer in the market, there are certain nuances which you should consider as a researcher. One is that underlying, just a second, the underlying commodity has to be free of monopoly or oligopoly. Why? Because if there is a monopoly flavor on one side, then the person will or the entity will control the price. For example, plastic is a derivative of linked to crude oil, but we cannot launch it in India because Reliance dominates one side of the supply side of the plastic in India. So all these things has to be remembered. One is this, of course, is free from monopoly or oligopoly. So there should be not perfect competition, but enough number of buyers and sellers in the market. Second point is this market should have less of less of government intervention. So I draw the analogy from sugar. Now sugar is a market which has not become successful in India for the simple reason every month or every period government announces some quota system for the factories to release in the market. And because government controls one side of it, this sugar market never picked up in India. Third is this price. What makes a trader interested is the price. Third is this price has to be very volatile. Why I'm saying? Because if the price is flat like this, then the trader will not get an opportunity to speculate. If the price has a volatility like this, then traders can easily speculate. Somebody is a buyer at this point as well as somebody can be seller at this point. So buyer will definitely lose by the time the price reaches this point, etc. So volatility is important of the underlying price. And fourth is, it is very, very important when you design a futures, choose a candidate for futures market, is the underlying market should be large. Why I say this, let's say consider the case of seedlac. It's a commodity which is, I mean, today it has become very obsolete kind of. When you used to seal envelope, at least in government or other places, people used to put a stamp, Bangla amra boli gala. So this seedlac is grown in Jharkhand region. But because the market is only around 2 CR per day, we did not consider, because what happens in case of narrow commodity, which is as small as 2 CR per day, 2 crore rupees, 2 crore per day, then anybody can easily manipulate the market. So these type of commodities are never considered for uh, for offering in the futures platform by any of the exchanges. Now, why we have chosen crude oil is the reason that crude oil is speculative. It is a global product. It is quality is very uniform. This is another consideration that we look at. The quality is very well defined. So, for example, in agriculture commodity, you cannot possibly decide let's say, any agriculture commodity you pick, rice, it must have 1,000 varieties. So, you have not seen rice as a successful futures contract in any of the global exchanges, but it's a very well-known popular commodity. So, quality has to be very well defined, not very fluctuating. So, all these qualities are inherent in crude oil contract. So when I chose WTI, I was discouraged by the then minister, Mr. Munishankar Iyer, or the Petroleum Secretary, or the FMC. Now, market regulator for the market is SEBI. Then it was FMC, which was subsequently merged with SEBI. So FMC was the market regulator then. So FMC discouraged me and the team from offering crude oil as a product for futures market or taking it to the government for allowing it in the including in the list of 140 commodities. My logic was why I settled on WTI, not on Middle East. It's a classic case of researcher's dilemma, because WTI is a contract which is seen by everybody. It is always under the discussion. So if the price is not understood to some extent by prospective participants, then the contract is bound to fail. How many of you know Middle East price? Perhaps none. But when I say WTI price of crude, possibly you will say it is around $20, $30, etc. But Middle East price, we don't know. So price has to have some visibility, because otherwise your marketing efforts to popularize the contracts will be humongous. So we chose WTI, whereas this was MCX case, this was the case of NCDX, and the result is in front of you. NCDX failed miserably. They had a very theoretical logic because India imports Middle East contracts, so they settled on this thing. Now, this is the quality part of Indian crude oil contract, and this you also have to decide on the size of the contract. When I say size, what I mean is basically the value of the contract, right? So US contract, the parent of the most liquid contract that is traded on CME, it is based on WTI, and the other benchmark variety of crude, which is Brent, which is also very liquid, which is on traded on ICE, Intercontinental Exchange. So these two exchanges have a very large size, large value contract, which is around, if I'm not mistaken, it's long back, I forgot a lot of things, 1,000 barrel. So in India, 1,000 barrels then would have meant 25 lakh value of each one contract. But Indian, now if your margin money is, let's say 10%, that means to trade one contract, the investor has to deposit 2.5 lakh in the exchange upfront. Because it is huge for the Indian market or Indian pocket in 2005-06, we decided to do it differently. We decided to reduce the contract. So the what you see on the MCX today has a lesser size. It is around 100 barrel, which is 1/10 of the parent contract. Why I'm saying parent contract? So India does not have the infrastructure to end the contract into definite delivery. So when the contract expires, so let's say this crude oil contract in India expires every 30 days. So every month you have an expiry of the crude oil contract, right? Now, upon expiry, usually you are given two choice by the exchange. One is delivery, compulsory delivery, that if you have your position open in the market, that you have bought something and not financially closed it, your position is open, so you have to take delivery from the exchange designated places. Other is a cash settlement. So you can close the contract during the life of the contract, or you can close it on expiry as forced by the exchange. So this is cash settled. We settle because India does not have this delivery system. US has that. So we decided to go for this cash settled contract. This cash settled contract, and the quality is WTI. And in the contract note, if you go to mcxindia.com website, you will figure out this underlying quality of MCX WTI contract exactly matching the NYMEX, which is a NYMEX division of CME. NYMEX is a division of CME where this benchmark crude oil contract is traded. So this WTI is exactly matching your NYMEX version. So quality is matched. Now the question remains unsolved with regard to delivery. So we decided to make it a cash settled contract based on the NYMEX price. So whatever the NYMEX closing price, we convert it into Indian rupee by multiplying the dollar value with rupee dollar exchange rate and offer a settlement price. So I give you an example. It's a very interesting example. So when I talk of commodity, how much time I have? Okay. When I talk about commodity, we talk about price, right? And price, usually we think the price cannot be less than zero. But actually, price can be less than zero if considering that it has a cost of storage. So this is the, anyway, I think I should skip it because there is not much time. It is almost hitting 11. So this is the crude oil contract for you. So we spoke about contract size. We spoke about monthly cash settlement nature of crude oil. We spoke about underlying quality. We spoke about it is settled on CME NYMEX, and what last line, what influences the contract. So every contract has a fundamental reason to move. In this case, what moves the contract is inventory. So crude oil inventory is the one of the major factor that moves the price of crude oil. So, and who participates in the contract are basically energy players. So it could be Indian Oil, BPCL, and all those people, and of course the speculators. Now move to the next point of interest, which is natural gas. Good that we have spoken most of the things, the parameters, etc. I just briefly therefore touch upon this natural gas. When I say natural gas, again it is a replica of what is traded in NYMEX division of CME. This contract in India has 12,500 MBTU as unit. That earlier crude oil was 100 barrel. It is possibly written this way, 12,500 MBTU. And again, this is some fraction of CME contract size value-wise. So this is your natural gas contract. One interesting feature of this natural gas contract is, unlike the crude contract, which is crude is highly storable, this natural gas is hardly storable, but people store in the US. So there is a natural gas hub called Louisiana. From here, upon expiry of the contract, this Louisiana has a lot of pipelines, and the people who have open positions, they get the delivery of natural gas, or they supply the natural gas for delivery, the sellers from the Louisiana pipeline. But in Indian context, this MCX context, we don't have this thing. We spoke about this Hajira pipeline, but that never materialized. The ultimate plan was, when we designed it, that initially it has to be cash settled, then we move for delivery contract. But this Hajira pipeline possibly has a lot of infrastructure limitation, and then taxation regime in India was non-GST. So every state used to have different taxation. So we went for cash settled nature of natural gas contract. So this is how it is for natural gas. And as I said, in crude oil, what moves the crude oil was inventory. In case of natural gas, what moves typically are two factors. One is cyclone. Whenever cyclone comes in the US, like I remember a few years back, it played havoc with natural gas price, which is cyclone called Katrina. So whenever when the cyclone hit the Louisiana hub, the market moved like a crazy price. It showed a very random price movement. And the second portion is that what moves the crude oil price, sorry, natural gas price is the temperature, because most of the natural gas are used by consumers for heating purposes. So one is the cyclone natural event, nature's event, another is temperature. So these two are one of the fundamental reason why this crude oil price moves. And who use these natural gas contracts? In India, it is basically speculators, but in US, there are a lot of hedgers also. Like, for example, Steel Authority of India has reasons to use it. In the case of US, BP use it. And there are a lot, Shell use it. There are a lot of big corporate who participate. And the size of this market is not less than, I once estimated, as big as this $1 trillion. So it's a huge market that is present for natural gas in the derivative segment. Having said that, we move to, now we have covered these two commodities which are storable. One is crude oil, one is natural gas. Why these commodities are primarily launched in the market? Or for balance two, one is weather, another is electricity. Only motivation, because when you write to the regulator or convince the government or the general critics, you can't say, I want speculators to come in the market to trade. But speculators, without speculators, market will never run. That is another learning of this market microstructure studies. So, what we discussed is basically storable commodity. Now, storable or non-storable both has an important function which is called hedging. What is hedging? Hedging is basically, so I have a price risk. How do I mitigate my price risk? Like, you have a health risk, you buy an insurance. Now, insurance premium that you pay to the insurance company, let's say national insurance company or whatever, Oriental, is basically a money which you have considered lost, but in case the disaster strikes on your health or something, or family people health or loved people health, you can revoke the insurance and get the money from there. So it's a premium that you paid expecting some events which is unwanted. In case of futures also, you launch a futures contract expecting a price movement which is adverse to your interest. So you are an importer, let's say. You are an importer or exporter. So you have exported to some foreign country and you are getting some dollar as payment from foreign country into India. Now, what is your risk? If the exchange rate of dollar is 75, then the multiplication of dollar with this giving you some results. And if it is 70, it will give you a lesser value. Am I right? So basically, you have a risk on dollar fluctuation. So you need to hedge this risk or mitigate this risk. So what you will do in the exchange market, you will buy a USD INR futures So USD INR futures rising from, let's say, or you sell here on the exchange market. So it is currently at 75. If it's say you have sold the market, if it drops to 70, you gain 5 rupee here. So this 5 rupee will be able to compensate the loss here. So this is the beauty of hedging in the market for an exporter. Likewise, you can hedge your commodity risk for natural gas, crude oil, or whatever you are trading. So motivation for starting a exchange traded futures market or day option market is basically hedging, and to make hedging successful, speculators are obviously required. Without them, hedgers will not be able to park their ports. So that's a different topic. Now we move to weather derivative, and finally we'll touch upon this electricity. That is a formal PPT presentation. Now, what is weather derivative? I think Digantada must have covered. I've seen certain things because you spoke about HDD, CDD, and all those things. So these contracts are traded in your CME. These are hugely popular contract. Why weather derivatives are needed? Because temperature fluctuates, and fluctuation of temperature affects many things. Let's say, for example, heating. Now, companies which make refrigerator, AC, and all that, they basically are from this area. Let's say companies which are producing, let's say, diesel